Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another velocity banking review. But before we get started, I just want to give you all a quick pep talk on how to master not only velocity banking, but any subject out there. And the biggest impediment that you're going to have when it comes to your mindset is that you're always trying to seek novelty. And you have to get to the point where this is not going to be exciting to you. Heck, you might be sick and tired of teaching or learning velocity banking, and that's perfectly okay, right? Because novelty is what beginners seek, right? And if you want to be a master, you just do it over and over again. Remember that Bruce Lee quote where he is like, I fear the man who does one kick 10,000 times. And I don't fear the man who does like 10,000 kicks once. The problem with most people is they're always trying to do 10,000 kicks or 10,000 different types of kicks one time. And that's why I do the opposite because I want to get good at this, right? That's why I make pretty much the same video over and over again, over 900 videos. And it's just me doing the spreadsheet, right? And we're just going to keep practicing over and over again. And once you get so good, you might be sick and tired of this. Okay. You might be sick and tired of saying, hey, my mortgage is paid off in 2 years and 9 months. I've said this so many times, I'm sick and tired of it. And then you just kind of have a skewed frame of reference when it comes to paying off debt. Right. And here's the other thing, too. Think about things that you're really, really good at and how much they excite you. Right. So, for example, if you're a native English speaker, how exciting is English to you? It's not at all, right? Because it's just a normal thing. So that's why I tell you, like, oh, when you're paying off debt, and you can say, like, oh, paying off a mortgage in 2 years and 9 months is not a big deal, right? And that's because I'm just teaching it over and over again so that, I'm at a point where it's so totally normal that I might even get sick and tired of saying it, which I do. Okay. I honestly kind of do get sick and tired of it, but it's okay because that means I'm at the level of becoming a master. Right. That's the burden that masters face, that we get bored by our own teachings. But I'm still having fun, okay? But I just want you to know that it's okay for you to do the same spreadsheet over and over again. By the way, my name is Tanya. If you don't know why my name is Tanya, go watch the last video about joining a cult. But let's go ahead and get started. So, what is velocity banking? All it is a debt payoff strategy where you throw all of your money into something called a line of credit, right? So basically, all of your money goes into debt and you're not saving money. And you're doing that with the help of something called a line of credit. So, in order to do velocity banking, there's only two things that you need. Number one is your budget. So, you have your income here, expenses here, and then you see here, you got negative savings. Okay. And then with your expense breakdown, you list every single debt that you have, right? Because this is a debt payoff strategy. And our goal is to make sure that all of these line items eventually hit zero, 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 right? And to make sure that we paid all of our debt, and eventually we're gonna have so much left over that we're gonna have what we call rich people problems, right? What's rich people problems? Basically, when you got too much money in your savings account. See, like this is the exact opposite of poor people, and you're like nervous because like, oh, my money's growing at like less than, we'll say, 4%, right? And inflation is, we'll say, 6. Rich people get nervous about that, so they always want to put the money deployed to use. And what our goal is essentially to get the rich people problems, okay? So what we're going to do is do the opposite of how the average American is trained, which is the average American feels like they need a savings account, right? Like they feel ashamed when this is not zero and it's not a little bit positive, okay? And we're going to do the exact opposite with velocity banking, because all velocity banking is just not saving money with the help of something called a line of credit. Okay. And that's really the number one rule, kind of like Fight Club. Like what, but there's that saying, well, what's the number one rule about Fight Club? You don't talk about Fight Club. Number one rule in velocity banking is you don't save money. Okay. So you see this, I don't save any money right here. It doesn't matter how much money comes in. If you got debt, you just don't save it. Right. And a lot of people will freak out about this. They'll be like, you don't have 3 to 6 months of savings. No, because I'm actively using that money, deploying it to pay off the debt. Right. So That's what we're going to do, not save money. Now, we also assume, okay, we have the same income and same expenses. Okay. Now, here's the other thing too. If you ask the average person, like, hey, if you're making good money and you have a lot of debt, right? Because this is a lot of debt, and you got negative savings, you're withdrawing your checking or savings, right? Do you need to make more money to get out of this hole? And pretty much everybody you know will say yes. And then they'll say there's something wrong with you if you haven't saved 3 to 6 months, right? That's like kind of like how Dave Ramsey says you got to save $1,000 and then pay off some debt, which is a good idea. And then later on, save 3 to 6 months. I ain't doing that. I'm not going to save any money at all, ever, until I got my debt paid off. Okay. And so what we're going to do is have something called cash flow and also have something called a line of credit. So, what's a line of credit? All it is a financial tool where you could borrow money, pay it back, and then use it over and over again. So, like this one right here, this is my $280,000 home equity line of credit. I think I'm going to have over $600,000 in lines of credit soon, over 600,000. Okay. Home equity line of credit, home equity, right? I might get another home equity for extra 10 because of investment property where they'll only give you $10,000 for a 50% loan to value position. But I'll talk about that maybe another time. But okay, so what am I even talking about? So what is this? Basically, I can take out up to $280,000. I could literally click my smartphone, dump $280,000, and they'll charge me a 7.5 interest rate, right? 7.5% interest rate. And I didn't even know these things existed before I did Velocity Banking. Like line of credit, I thought the only types of lines of credit that existed were credit cards, right? But we have a home equity line of credit, personal business line of credit. In fact, if you just do some simple Google searches, right? Let's just do this personal, they're like, where do I get a line of credit? And I'm like, Google is your best friend, buddy. Or maybe Chat GPT nowadays, right? So business line of credit. Well, this one is actually a loan in disguise, but the personal line of credit, Capital One, PNC. Look at this one, unsecured personal line of credit. I got two personal lines of credit for 15 grand each and an $8,200 personal line of credit. I got tons of them. I have over $594,000 in lines of credit, mostly credit cards because a credit card is technically a line of credit, but I like the other lines of credit too. You need all of them, right? So in this example, we're going to assume we have an $80,000 line of credit. Now, here's the thing. If you're in the negative savings, will a bank ever give you a line of credit? 98% no chance, right? There might be a 2% chance, but I'm not going to teach you that because it's going to give you a bad personal foundation. And what I mean by that is that banks don't lend money to people who need it. Okay. And so if you ever try to get money when you need it, that's giving you a bad foundation when it comes to finances, right? What you want to do is get the money before you need it. So think of a line of credit in this case as like an insurance policy, okay? Now, if you ever try to not drive with insurance and then crash a car and then get an insurance policy afterwards, that's going to be really tough, right? Like you want to get the insurance policy before you start driving, not after you crash the car when you don't have insurance. That's what the bank sees when you're in this position and you need money and they're like, we're not going to give this guy a line of credit because he needs money, right? So be aware of that. But what if we did have a line of credit? Okay. Do we need to make more money? And the answer is, I don't know. Well, let's just do the demonstration. So this is going to be $70,000 in credit card debt. So you see these three credit cards, $70,000. Well, guess what happens just by simply transferring the debt? 0, 0, 0. My goodness. How do we go from negative $126? Again, we didn't make more money, right? We didn't make more money. Negative $126 to $2,236.35 of cash flow. How do we do that? My goodness. This is the most insane thing that you will experience when you realize all you had to do was redirect the flow of money, right? It's insanity. How do we go from negative 26 to 2,000? just by simply moving the flow of money. And then the final step is you put your entire paycheck, this entire 6,500 into the line of credit. And then you take your expenses out and then you rinse and repeat over and over again. You rinse and repeat over and over again. Paycheck in, expenses out, rinse and repeat over and over again. And the balance of the line of credit is going to go down by $2,236.35. Isn't that amazing? All right. So let's go ahead and do the math. And one thing I should actually mention is, how do we know which debts we move to the line of credit? The easiest way to know is by using something called a cash flow index. Okay. So what is the cash flow index? And let's just do a quick Google search. All it is a formula of the balance divided by the minimum monthly payment, right? So what it's going to do is just give you a number, and you think of it as a ranking system. So let's just kind of quickly calculate this, okay? So it's going to be 5,000, which is the credit card debt, divided by 175, which is the payment. And then this is going to be 30,000 divided by 1050. Whoopsie, not 4050. 1050. And then this one, whoopsie, I screwed up. All right, 1050. And then this one is going to be 35,000 divided by 1137.5. And then luckily with these loans, I got these cash flow indexes here. Let me go ahead and copy and paste. Okay. And so you can see that this is, it gives you a number, and think of it as a ranking system. So the lower numbers, okay, the lower numbers are the ones you want to move into the line of credit. Okay. And where like the below 50 is usually a good candidate. But what does the low number mean? Well, basically it means you get more bang for your buck in terms of cash flow when you move the debt into the line of credit. So for example, $35,000 of debt for $1,100 of cash flow. Pay this one off, or you could pay $250,000 of debt to get $1,100 of cash flow. Which one gives you more bang for your buck? It's obviously this one right here, right? So that's what the low numbers mean. More bang for your buck. It's okay to move into the line of credit. Sometimes it's related to the interest rate. Other times, especially with amortized loans, it's also related to the length of the loan, right? So let's go ahead and move these, which we already did. And that's how we know cash flow index, where to move it. And I'm going to go ahead and do this. Get the next month's balance, previous month's balance, or previous month's balance is the next, right. Next balance is the previous month's balance, and the previous month's interest minus our cash flow, 2236.35, right? And then what we're going to do is take the average daily balance, multiply by the interest rate, and then divide by 12, right? So $459 of interest for the line of credit. And then we just keep rinse and repeat over and over again. And we're just going to pay off that debt. You see that cash flow? Listen, if we're doing banking the traditional American way or the average American way, we wouldn't know what to do. We're negative $100. What do we do? Right? We're screwed. Okay. How do we pay our bills? And that's okay. And let me actually clarify this. The difference between the average American and the Velocity Banker is, what is your main operating account, right? So even though it's the same income, we're paying for things out of our checking account and leaving the leftovers or savings. Whereas when we're doing Velocity Banking, we're using our line of credit as our main operating account, meaning we put all of our paycheck into the line of credit, and then we take our expenses out of the line of credit, right? And then we always make sure that the savings is zero. Paycheck is the main operating account here. Here, it's the line of credit, okay? So let's go ahead and finish this up and pay off all our credit cards. And then we see that in 36 months, it's all paid off. 36 months, whoop-de-doo. All right. So 36 months, and that was how much? 70K? 70K. All right. And let's do here. And then now, luckily with these loans, we got the loan calculator that can help us figure out what the current balance is. So the three factors that determine the payment in an amortized loan is the original balance, the interest rate, and the term. And so if you know how to kind of deal with Microsoft Excel, you see the payment formula right here, right? And then it gives you And then you can use that to kind of figure out the latest or current balance, right? So you got all these formulas here to help you figure that out, okay? And also the amount of interest that you paid. Amazing what you can learn, right? So let's look at the cash flow indexes here, right? I pay 8,900 to get $386 of cash flow back in my life, or should I deal with these higher cash flow indexes? So even though this has technically the lowest interest rate, we're going to focus on paying this one off first because we're just getting more bang for our buck in terms of cash flow. Okay. So let's go ahead and move this 8 grand into that line of credit. All right. So plus 8906.11. And then, all right, so this is 0. And now our cash flow has gone up to $2,623.10. Okay. So let's go ahead and do that and undo this. And then this is going to be 2623.1. All right. And I'm going to do this 39 months, and then this is going to be 91K, 91K. All right, so now let's go to 39 months right here. So this is 0. This is 39, right? And then you see that this is the ranking order. So we're going to take the next lowest one, pay off the 40 grand to get about $583,000 of cash flow. Now, when it comes to amortized loans, okay, the higher the spread of the interest rate, the more we have to be a little bit careful, right? And so we're using an 8% line of credit to pay off a $40,000 5% loan. Now, the safest bet is using something called a chunking method, especially when there's an interest rate difference. Now, I have an 8% investment loan on a rental property, and I don't really mind if I move it into a line of credit. I feel like there's no harm. But if the loan was at a 3%, I would be very, very careful into moving that loan in a line of credit, right? And so the safest way to pay off that loan is using something called the chunking method, which is you just take a piece of the loan and move it into a line of credit. So what's our income right now? Our income is 6,500. So let's say, oh, we'll move $7,000 of the loan and move it into the line of credit. And remember, the cash flow doesn't really increase until the loan is completely paid off. But you see right here that we just moved a $7,000 chunk, and then after 3 months, then we paid that $7,000 off relatively quickly, right? And I'm just going to show you with this velocity banking calculator that when you use the chunking method, heck, you can even do like a 30% credit card if you're insane. And the effect is there, but it's not as insane as you think it would be, right? So let me go ahead and do this right here. So we have a $55,000 student loan, 55,000. All right, so 55000. And then the current balance is 40034.51. 40034.51. And then what's the interest rate? It is 5% at 10 years. Current balance is, no, I already did the current balance, 583.36. Okay, and then the monthly income is 6,500. So we're gonna chunk 7%. And the expenses is everything except for the loan we're trying to pay off, right? So we're gonna take a look here, and I'm gonna copy and paste this, right? What's this? And then we're gonna sum it up. So that's gonna be 3293.54. So 3293.54. Whoopsie, not 329. So 3293. All right. So 1.1 years to pay it off. Now, let me just do a quick comparison of if I put the entire 40 into the line of credit, what would happen? It would relatively be the same, right? It's an extra $500. You see that? Right? You see that? So the reason why I say that, actually, you know what? Would this decrease? No, would it? Actually, no. Okay, I'm right. All right. So here's the thing, right? The higher the cash flow index, like this insane 190, and the lower the interest rate, the more there's a difference, Like the more this number is bigger, and the less this number is smaller, then that's going to affect how much interest you pay. Okay, so just be aware of that dynamic. But in this case, it was not a big deal. But here, actually, we paid it off a little bit quicker. That's interesting. But we paid a little bit more interest. All right. So 1.1 years, we're going to pay off the student loan. So that's going to be 39 plus 1.1 times 12. And then it's going to be 53 months that we're entirely paid off, right? And well, let's go here. Let's see, raise this. So it's getting 91 plus 55, 146K. And then, right, and so it's the mortgage is 250,000 at, where are we? 53 months, right? So 53. So this is 0. And then now we just plug it in the velocity banking calculator. So 30, 0. And then I think this is 2100. Let me just quickly check. 2100. Yeah. So 1193.54. Okay. So now we just got to plug in the numbers. So what's the original balance of that mortgage? It is 250,000, 250,000. And then what's the current balance? The current balance is 229,156.8. 229,156.8. All right. So now you see here that we paid off the mortgage in 4.8 years. 4.8 years. Okay. So let's go ahead and do this right here. And then there'll be like 53 divided by 12 plus 4.8. And then 9.2222 years, debt free. Now, some people might argue that, hey, instead of paying off your cheap 4% mortgage, why don't you invest in the rental property, right? And that could be a legitimate suggestion. I'm not saying I would suggest it. It's all dependent on you. But let's just say we're at a point where we did decide to pay off our mortgage first. Then let's go ahead and invest in real estate. And if we take a look here, $210,000 for a $318,000 property, right? I bought this at the peak of the market. Now I honestly figured that I could probably have done a little bit better, but it's okay. It's okay. $210,000. That's okay. $100,000 discount. I'm good with it. Maybe next time I get a $200,000 discount. But here's the trick, especially when it comes to real estate investing and not your own personal home, you got to learn how to buy it at a discount, right? So let's say now, because our home is paid off, now we get a gajillion, a huge line of credit. And again, you can use a loan or a line of credit. I don't even care. But let's just say we get into a property for $200,000 all in, $200,000, right? And you're going to fix it up, buy it at a discount, put some repairs, and then this is what we're going to do. Okay, so we're going to get a tenant in there for $2,000 a month, $2,000 a month. And then we're also going to multiply this by 0.7 because the income that we get, we send 30% of it goes to expenses and we keep the 70, right? And then look at this, our cash flow is 5,800. And let's see how quickly we pay off our first rental property after we're debt free. Okay, so let's go ahead and do that. Paycheck in, expenses out. And we see that in 40 months, we paid off a rental property. 40 months. How much is 40? So 3.3 years, rental property paid off. Isn't that amazing? Like you literally paid off a rental property that most people would take to pay off a car. Now you got the cash flow. You're swimming in equity. You got a ton of equity, okay? And now you could either get your next rental or just chill out because $5,800 a month is good enough for you, okay? All right, well, that's it for today, folks. This is Korean Atlanta Mentorship. Remember, just get to a point where you just do this over and over again, and you may even be sick and tired of teaching or learning velocity banking. but it's actually a good sign when you're at a point in life when you say, "Hey, I paid off my mortgage in 2 years and 9 months," and it's totally normal to you. You don't even blink an eye. It's like speaking your own native language as an adult, right? There's no excitement, but it's just your normal everyday life, and you built a good foundation for yourself. Okay. All right. Well, that's it. My name is Tanya. Have a great day, and this is Green Atlanta Mentorship.